Good afternoon and welcome to this afternoon's webinar from Dun Bradstreet, titled A Unified View of SME Credit Risk. This is a new quarterly webinar series. Today we're looking at data from Q2 2024. So delighted to introduce our speakers today. First of all, Grant Hickson from our senior economist team, Ravi Sidhu, who's a subject matter expert in credit risk, and also Mike Conroy from our partner UK Finance as well. So Grant, if I could ask you to kick off with the economic pulse check through an SME lens.
Yeah, thanks, Stephen. So over the next 5 or so slides, I'll talk about the UK's general macroeconomic condition, also prices, interest rates, lending, and the impact that these things may be having on business solvency. Before I start providing the update this time around, I think it's worth briefly looking back at the first webinar in this series, which we did back at the beginning of Q2. And my broad take of the UK economy 5-6 months ago was cautious optimism. My caution reflected the headwinds facing businesses, in no small part related to the cost of living crisis. And while that particular collective headwind is still an ongoing issue, I think there are reasons to still be optimistic, even if we've had some signals that business activity might be losing a little momentum. And that optimism begins with GDP data, which showed in the first half of this year that the UK's economic growth outpaced that of any other G7 country in that period. The OECD today said in its latest outlook that it expects UK economic growth this year will likely be much stronger than it had previously thought, and even ahead of Germany. The headline growth number obviously masks a variety of experiences for businesses, both positive and negative. And while most firms will perhaps say they're getting a better handle on prices, they, however, cite that soft or patchy demand has been a factor that they've had to deal with. Uneven demand has affected consumer spending. If we look at the grey line in the chart, we can see that inflation has gradually been slowing and returning to the 2% rate that the Bank of England targets, and crucially is now below the dark blue line, which is nominal wage growth. And so wage growth has been outpacing inflation. In time and in aggregate terms, what that should translate into is an easing of the cost of living crisis, and so a pickup in demand. But look at the path of inflation, and that's a big factor that has affected consumer spending. It's been high and fluctuating up and down, which has created challenges for consumers and businesses, and also made the Bank of England prefer to wait and see for more validation before deciding to ease policy. As I say, we've reached the threshold, at least by some measures of inflation, that is consistent with meeting the bank's criteria for easing policy, and businesses in the economy more broadly should be boosted by lower interest rates, which the Bank of England has been able to move towards, and it's captured by the slight dip in the light blue line, and should continue to pursue, though the pace and timing towards cheaper borrowing costs is not particularly clear at the moment. And the bank looks across various measures of inflation and other indicators of macroeconomic health, which are relatively volatile. It also looks at what other central banks, especially the Fed, are doing. And it isn't particularly clear what the Fed is likely to do in the short term. And so perhaps when you include those factors, the future path of UK monetary policy isn't as clear as it might look at face value. Next slide, please. So there are over 5 million small businesses in the UK, and these high input costs are likely to have affected most of them to some extent over the past couple of years, hitting some harder than others. Smaller businesses are likely to be less able to adjust prices they charge for goods and services compared to larger businesses, who have the ability to set prices more easily given the size and scale. But also look back 6 months ago, and the operating environment was much less clear than it is now. So while big firms may have cash reserves or other ways to sit tight and ride out tough conditions, smaller firms may have felt under pressure to react by raising prices just to stay alive. And the bar chart here shows the results of a recent survey conducted by the ONS, asking firms what's caused them to consider raising prices. Aside from a large number, around half, now no longer considering raising prices, which in itself is an important point as it implies that prices may be returning to some stability. A significant proportion of SMEs said that labour costs are still a big issue. Employing people is a large part of input costs for businesses, and as we've seen on the previous slide, wages have been growing strongly, and some businesses have responded by putting up their prices to cover those costs. Perhaps there's some effect of smaller SMEs under wage pressure because they've been operating in an environment of wider rising wages. and so feel under pressure to lift pay themselves, because their workers will look at the larger SME down the high street and see that they have more easily lifted wages and just go and work for them. Fully 1/4 of SMEs expect staffing costs to rise over the remaining few months of 2024. So it's worth kind of highlighting, perhaps we haven't seen the end of rising wages and the impact on inflation just yet. Next slide, please. So one way to deal with these additional costs is to seek lending. And the value of outstanding loans to UK SMEs has continued to fall this year, with political uncertainty and the pivoting of monetary policy at the Bank of England creating some hesitation around future lending. Banks tightened borrowing conditions and reined in lending to SMEs as interest rates began to increase. So we may see some lending requirements relaxed as interest rates are lowered. In contrast, as the chart shows, loans to large businesses increased, or more accurately, they fell in the immediate post-pandemic period, then recovered. Potentially, this is the effect of high interest rates appearing to be less attractive to large businesses who may have alternative resources. Larger businesses may be more established. They may have higher turnovers, perhaps viewed by banks as being lower risk borrowers than SMEs, where perhaps SMEs may have little other option but to take out loans at higher rates. I think it's fairly common during periods of economic stress to see banks pivot away from SMEs in favour of lending to bigger businesses. And I think that's exactly what the chart shows. My view is that I think until the economic picture starts to become more clear, smaller firms probably likely to find bank lending hard to come by. Next slide. So tied in with the view of outstanding loans is the price of borrowing. This chart plots effective interest rates for SMEs on new loans, both fixed and floating rates. And interest rates on both have risen sharply over the past few years, but borrowing costs, may be beginning to come off. And with that, we may see an increased appetite for borrowing. Looking back just a moment at the last webinar we did, those lines in the chart were at a high point without the plateau. And it wasn't particularly clear how much higher interest rates might go. And since then, rates on loans seem to have reached a peak and not increased any further. We're still at about 7.5% compared to closer to 4.5% in the pre-pandemic, pre-Bank of England rate hike period. And future interest rates decisions remain unclear, as I mentioned, but they appear to be heading lower. So demand for loans by SMEs is one factor at play, and we can expect increased business confidence and falling interest rates to lead to more demand for loans. And we may also see an increased appetite from lenders. The question is, what does that mean for businesses? Well, potentially it means that plans for growth and investment could be back on the agenda. Next slide, please. So using our data here at Dun Bradstreet, we track business closures in the UK by sector. Last year, that rose to 25,000 alone, compared to somewhere around 14 to 15,000 a year pre-COVID. What we find in the latest data is continued high levels of business bankruptcies that we've seen over the last couple of years. And in the latest data for Q2 2024, construction accounts for around 15% of all bankruptcies. That's the largest segment. 920 odd construction firms went bust in Q2, according to our data, meaning that about 10 construction businesses went under every single day in Q2. Material and labour costs are high, and funding is still tight for construction firms. Political uncertainty, I think, has also been a factor, particularly in the run-up to the general election. That goes beyond the construction sector. But construction is one of those sectors where there's often a significant chunk of investment kicking off a development, for example, and changing government or changing political priorities may mean a change of regulation of the sector. Overall, my interpretation of the data across all sectors is that while we're not seeing rates of business failures slowing down just yet, we're also not seeing a further increase. Ravi has some interesting data coming up on the probability of current account default across these sectors, including actually some fairly positive signs from the construction sector. I'll end by mentioning that we conduct a forward-looking quarterly business optimism survey here at Dun Bradstreet across different sectors and business sizes. The data behind this are available. And what UK firms tell us is that they're feeling more positive about their prospects than at any time during the past year. So, at this point, Mike, it would be great to hear your views and what you're observing from your members at UK Finance.
No, great, Grant, and thanks for that overview of the economic picture. I certainly would recognise a lot of what you say. The UK economy has continued to recover from the. I think we could all agree it was a mild recession at the end of last year, and as you were saying, the number of surveys that measure business confidence, have indicated improving sentiment across all business sectors going into the second half of 2024. And I certainly recognise the easing of inflation and hopefully the prospect of lower interest rates over time. Although, as you were saying, the borrowers, looking to borrow now are facing, higher interest rates, and lenders are factoring that into their decision making. I think our members are definitely seeing differences by sector, but also differences by business size, and it seems that the micro businesses, those employing sort of less than 10 people, are particularly feeling the strain at the moment. The monthly profile of growth of the last quarter was quite bumpy and not entirely rosy across all parts of the economy. The service sectors, this is often the case, did all the heavy lifting in Q2. And growth was sort of widespread within the service sort of subsectors. But it did make the first half of 24 the strongest 6 months for services since H1 2022. Within services, the picture did look weaker for consumer-facing sectors, and I think that we'll see that as a fairly common theme, throughout this particular sort of webinar. And I think that in part reflects the cautious consumers that are still burdened and bearing the scars of the recent period of high inflation, rising costs more generally, and obviously rising interest rates, and the disappointing wet start to the summer sort of seems to have dampened down sort of retail sales. I think manufacturing, on the other hand, had a decent start to the year. Transport equipment was a drag on the headline manufacturing numbers, but perhaps not entirely unexpected, as car makers were making changes for production lines for new models. And of course, we're seeing changes related to the building of electric vehicles. And of course, JLR are an example of one where there's moving to an all electric operation, which of course means we won't see some new models for a while. You mentioned construction, and I think they've had a poor run of late, with output falling for the third quarter running. Order books seem to look quite fragile there. I think in terms of insolvencies, I think overall, actually, the low interest rate environment for much of the last decade has helped to keep insolvencies quite low. But obviously, that's changed quite recently, and there has been, as you've noted, an uptick in insolvencies. But I suppose, looking for a glimmer of hope, the share of the total stock of businesses going into insolvencies is lower than we saw in the sort of 2008, 2009 downturn. But nevertheless, it's an important metric to watch as the economy continues to recover. I think the other point to note on insolvencies is many of them are creditors' voluntary liquidations, which is interesting. But it does seem that there's a post-COVID insolvency surge, which is largely driven by quite small micro firms. Looking at lending, the data we collect from the main high street banks did show year-on-year growth in gross lending in the first 3 months of 2024, which was the first time since the pandemic. In the second quarter, overall gross lending was broadly stable at 4 billion, but a little higher than the year previously. But I think, as Grant was saying, this some of the green shoots we're sort of seeing is coinciding with an annual growth in loan approvals. So perhaps the outlook is is more rosy than we've seen in the last sort of 18 months. I think, of course, any growth in lending is not universal across all sectors or regions, and We did note that regional lending growth was strongest actually in the East Midlands and the Northwest, but we did see a decline in Yorkshire and Humberside. Sectoral variation is also more pronounced. There was some lending expansion in sort of agriculture, some in construction, which is, actually probably a little surprising, given what we saw in terms of the the failure rates, but also in real estate. So as ever, you always find that there's some in a sector that will outperform how others are doing. But I think at the other end of that spectrum, lending in H1 24 was down year on year in manufacturing, and also in SMEs involved with transport, storage, and communications. But overall, I certainly recognise the picture that Grant was painting.
That's great. Thank you, Grant, for the macro overview, and also Mike for your UK finance view. So, Ravi, I think it's over to you now for some of the insights in regards to commercial credit data.
Great, thanks, Stephen. So in terms of the views that we've had so far, we've taken more of a macro view, and one of the key insights that we wanted to bring in with the input of the data that we're going to be sharing, and Stephen, if you just move over to the next slide, is going to be based around CCDS data, or commercial credit data sharing scheme. Now, I'm aware that some people that will be listening in will be very familiar, and others will be less so. So what I'm going to do is just talk through what the CCDS scheme is and why it came about, and really what the benefit of it is. So in terms of what the CCDS scheme is, post the financial crisis in 2009, as we were coming out of that, the government wanted to encourage SME lending, and so part of that initiative was to share more data around the lending that was happening within the SME market. And specifically, they mandated the banks, the 9 designated banks they're referred to, and you can think of them as typically the high street lenders, to share their data within this scheme. And that was really to encourage more broader lending, to encourage other lenders like challenger banks that were coming up at the time, that made quite a small proportion of the market at that point in time, to encourage them to actually support SMEs. I think if you look today, whereas the proportions were 80-20 in the past, now the challenger kind of proportions are more 50-50 with the high street banks. And so to some extent, it's worked in terms of what it was trying to do, encourage lending. So why is this data so useful? Well, this data includes loans, cards, current accounts, and in effect, it covers all SME businesses with turnovers of up to 25 million. And that may sound like a limiting factor, but in reality, that covers 99% of all businesses in the UK. So it is very expansive in terms of what it covers. And in terms of where it can be used, most credit providers can use this. So we're talking about lenders or people that are providing trade credit. They can certainly use the Dun Bradstreet scores as a minimum. But equally, if you're contributing to the scheme, so if you are contributing loans, cards, asset finance, invoice finance, you can then also access the underlying data. And from what we're hearing and what we're seeing across the market, there are several banks that are using this, and as well as challengers and newer startup fintechs. But there are still pockets where this data isn't being used. So I think, as much as it's great to have the input of the data within the scheme, ultimately it's really good for making decisions. And, that's really why we like to talk about it. It's a scheme that's really useful for all the people that put into it. Just want to pause here just for a second. Mike, I know that previously we co-authored a paper, and we talked about the benefits of the scheme. What are your thoughts today in terms of the scheme?
Yeah, I think, Ravi, overall, it's been a beneficial scheme for the market. As you say, it's been around since 2015, and I think it has enabled better access to finance. and I think it's supported competition. And you were describing that deeper pool of finance providers that exists today. But of course, the market has changed quite considerably since 2015, when those regulations were put in place. So alongside that, deeper number of finance providers, and I think our recent estimates is certainly in excess of 300. That there are also more providers of business current accounts. So although we've got these, as you said, 9 designated banks at the moment, there are some brands these days that have been very successful in growing their business current account business, and of course they're not mandated to report data into the scheme. So I think the scheme would benefit from a review, because at the moment the coverage is incomplete. And I think what that means that for some SMEs, if you want to borrow, you could find it more difficult to obtain sign-out, simply because the data is not readily available. But overall, I think it's a well-intentioned scheme that has a little bit of room for improvement.
Great, thank you, Mike. So let's now step through the analysis that we have for you that we can share across the market. And I thought one of the more interesting ones was around mortgage lending. Grant mentioned that inflation is now coming within line with expectations. We're not seeing rate cuts happening just yet, but we're expecting them over the next few months. But I think one of the key things is that it's taken a while, and the volumes have dropped off in terms of mortgage originations. And you can see for the last 6 months or so in 24, the levels have been relatively flat. And what we can see is that that's probably a combination of either tighter lending from lenders, but equally it could be SMEs just waiting to refinance. So personally, I don't see this changing very quickly. I'm sure that as soon as those rates start dropping, we will start seeing a steady improvement within the market. And just to kind of emphasize that, it's not been rosy over the last few months or years. Even payment performance, when you look at the bottom chart for mortgages where they've missed more than 3 payments, which is in some ways quite severe for that kind of lending, you can see a steady increase. So yes, things will improve, but I think it will take time. So how does it look across other areas? So we talked about mortgages, new business loans. They've been steadily declining. What we're seeing with credit card lending, there was a peak probably in 23, and that's come off its highs. And so really where we're seeing significant growth historically over the last few years and kind of maintaining that is asset finance. And we talked about this 6 months ago when we last had our webinar, and we were cautious because we weren't sure whether that was going to end up with some pain in terms of payment performance. But the positive sign, as we move through to the next slide, what you'll see is the payment performance actually over the last 6 months has remained within line of expectations. The delinquency levels haven't spiked up. We did have a few spikes around defaults. We haven't really seen that materialize. So as much as there is growth in the sector, there isn't at the moment significant signs of stress. I think that's partly to do just the nature of the lending. You have a degree of protection through the collateral. And, it's one of those things where you still need to be careful in terms of how you lend, and you still want to lend responsibly because you don't want to put too much undue stress. So it's an area that we think is positive, but we'd like to obviously keep a close eye and monitor this through the rest of this year, but also through 2025. So just a bit more of a deep dive around business loan defaults. And I just thought this was really interesting when we were looking at the various charts. In terms of business defaults, they have been declining gradually, certainly over the last 12 to 18 months. But what you will notice is the value of defaults, that's the line that's just above it, that's actually widening when you compare it to the instance of defaults. And what that really is showing is the value of defaults is actually increasing. So I guess this is just a message really out to anyone who's actually looking at managing their credit lines and the limits and their exposures that, there could be a slight increase in what you're experiencing when it comes to defaults. And so therefore it's even more important to monitor the portfolios, make sure you're managing your limits and setting them and being on top of that so you don't incur unexpected increases in losses. So on the last two slides that we've got, we talked about current account turnover information. This is probably one of the most insightful data sets that we have within the CCDS scheme, because you can actually look at the flows of funds through the accounts. So the top chart looks at the average credit and debit turnover. And since COVID, that's been steadily increasing, probably leveling off a little now. What's more interesting is the difference between the credit and debit turnover, so the net turnover. And what you'll see is, on average, there's a £500 shortfall within those accounts. It varies over that time period. And so obviously, when we were looking at this 6 months ago, we saw this as quite a concerning trend. Clearly, SMEs are having to rely on their own funds or other loans. But what you can see, I think, in the last 3 to 4 months, that's actually reduced quite significantly. And I guess the question we have to ask at this point is, are we actually seeing the signs of actual improvement now? So what we've done is we've actually tried to have a view on that. And actually, when we move to the next slide, what you'll be able to see there is everything we've talked about to date has been actual numbers around originations or performance, and it's historic. What we're now looking at is trying to predict what we think will happen within sectors and which ones are experiencing more pain than others. And so the first chart that you see at the top there is really looking at the probability of default in the next 12 months. And what you can see is the highest risk one is highlighted as the eating and drinking places. And for reference, these tie up exactly with the categorization that Grant was referring to earlier. So it'll be interesting for you to actually have a look at those. And in the case of finance and insurance, that looks like, based on our scores, the lower risk sector. So less likely to default in the next 12 months or so. I think one of the key things is there's been some improvements. So transport, construction, and personal services, in the chart below, you can see they've had significant improvement from 2022, circa 8% compared to other industries. But I guess, there's some things that are somewhat inconsistent with some of the messages. At the same time, we're talking about construction firms that are struggling and they're going into insolvency. And at the same time, we're talking about some improvements within construction. So I think, what we need to remember here is, even when you're talking about individual sectors, there's going to be a whole range of businesses within those sectors. And actually, as some construction businesses fail, there's going to be others that are going to take up the slack and actually benefit to some extent from the opportunity that's there. So there's a lot of other factors that are happening within the market. So as much as this is a directional view, I think one of the key things is to understand how is that individual business performing, and getting the insight, whether that's from CCDS or our traditional data. It's one of those key points. So I'm going to pause here, and I guess, Mike, from your perspective, it'd be really good to get your opinion on, what you're seeing in terms of a forward-facing view on future of defaults, various sectors, construction, or any other sectors.
Lovely, thanks, Ravi. It's there's a lot of insightful data that you're able to present. I think the trend in finance repayments has remained broadly stable as SMEs continue to meet their payment obligations, and always worth reminding everyone. Of course, we've got the aftermath of COVID loans in place, and I saw an interesting statistic from the latest SME Finance Monitor data that we commissioned, that 40% of finance users were reporting that they're still repaying pandemic funding. And if you remember that bounce back loans could be pushed out to as much as 10 years, you can see that SMEs may have some element of debt burden for some time. The good news on the government loan scheme facilities is that just over 70% of the bounce back loan facilities by volume are either fully repaid or on schedule, which is I think better than many would have expected when the loans were first created. But over 5% of all scheme facilities by volume are currently in arrears, but they haven't actually technically been defaulted. But obviously, it's if they're in arrears, it's worrying signs. And about 1% by volume are currently defaulted. The government guarantees of so far that have been settled is about 20 odd percent. So it's an interesting scheme to look at in terms of what can happen if if no credit assessment is undertaken versus lending which is fully credit assessed. The value of repayments, I say, are running at pre-pandemic levels at the moment, and I think we expect to see that trend continue as SMEs seem to be preferring to pay down pandemic funding and prioritizing that over taking on new finance for business development. And another sort of indicator of financial stress is overdraft utilization, and the overdraft utilization over the last quarter was 48%. So that's little change from the previous quarter, but it's still well below the rate seen at the start of 2020. So as you can see from that, there's still quite a lot of headroom for SMEs with overdrafts, although over time the usage of overdraft has declined. The last quarter, we did see a significant overdrafting utilization across consumer-facing sectors. So I think that's a theme that we've obviously mentioned during the course of the webinar, and that's most notable in accommodation and food, and also recreation and personal services. And across both sectors, this trend did reverse in Q2 as seasonal pressures requiring sort of hospitality and recreation SMEs to use more of their overdraft buffers waned a bit, but still one and a sector I think to watch. But otherwise, SMEs in aggregate, looking at cash deposits, they've got a significant cushion of cash. That's been the state of play for quite some time. But there's almost at least, I think there's about twice as much out on lending as there is being held in cash. Certainly, as the economy reopened from COVID, firms, as we know, were hit with significant sort of price increases across a range of inputs. So that cushion has been being steadily eroded. But these deposits are still about 14% higher compared with the start of 2020. And to put that into a more sort of tangible way of describing it, there's about a quarter of all SMEs hold £10,000 or more in credit balances. So that brings that statistic a little bit more to life. The SME Finance Monitor has also revealed, to the point made about that Ravi made, particularly about the sort of negative cash flow, is that over a third have been making injections from personal funds into their businesses in Q2 2024. So that's consistent with that picture that some SMEs are needing to make those sort of cash injections to stay solvent. But I think from the lender perspective, lenders have been lending quite prudently for some time. So we've not seen, or certainly not hearing about any significant uptick in impairments. However, Business Debt Line, which is a service available to businesses that are feeling under sort of financial stress, they've reported increases in both business and personal debt, with average business debts increasing by 33% in the last year. So that's quite a notable uptick that they're reporting. And they also have been reporting that a substantial number of customers continue to report deficit budgets. So I think, again, that's sort of is in keeping with that, some of the data we're seeing. And that figure actually was as high as 51%. And just finally, and I shouldn't really be adding on a gloomy note, but about 21% of all zero employee SMEs self-reported as struggling. So I think, in summary of all of this, it's as you've been hearing, it's it is a mixed picture. There's still a number of sort of economic challenges and uncertainty out there. We've got obviously when people are uncertain to what the impacts the budget it's likely to have, but as ever these as Ravi was saying, that good business analytics are important, because even within sectors that look troubled, there are always those businesses that are performing well and above the average, and in sectors that are doing well, there's businesses that are struggling. So it's the analytics function in terms of managing credit risk is as ever very important.
Great. Thanks for that, Mike. And actually, that leads us really well into the next area, which is really talking about SMEs are under pressure. We've said that. We know that inflation has been coming down, but I think we all experience the fact that actually things are still just very expensive. So these pressures are still there. I think there might be light at the end of the tunnel, and I think there is light at the end of the tunnel, but I think it's a case of SMEs hanging in there probably for a little bit longer, because we have seen the perfect storm, with COVID and all the other knock-on impacts that's had. So it's almost been the perfect storm. And I guess, Mike, from your perspective, what do you see as the outlook for SMEs if they are looking for finance? What are their options, and how do you see that panning out?
Yeah, thanks, Ravi. Well, I think as I was saying sort of earlier on the call, we are seeing some green shoots. We did go through a period where SME approval rates were running at about they were running at sub 50% at one point last year, but we have seen that improve, which is encouraging. And as I was saying, I think overall finance levels tend to be ticking upwards and I think if we look further ahead, then if we see falling interest rates and borrowing becomes a bit cheaper and better economic prospects, then I think businesses will become sort of easier to lend to. But I think there are sectors or business types that always have greater challenges when it comes to access to finance, and those are typically startups and very young businesses that have got very little or certainly limited track record. But I don't think the supply of SME debt finance is a constraint on growth for the majority of certainly well-established and clearly viable SMEs. And as we were talking earlier about changes in the marketplace, and these days there are hundreds of business lenders, and I think overall in the marketplace, lenders are open for business, but as ever, credit appetite will vary by lender. And I think a trend that we have noticed in the last number of years is an increase in the use by SMEs of credit brokers. And I think what credit brokers seem to be bringing to the market is that they're very familiar with market trends and the requirements and risk appetites of the different lenders that they deal with. So they can help to shape lending proposals and ensure that lending applications answer and address the key areas that today's sort of credit writers are looking forward to. So I think overall, in summary, lenders definitely open for business, but in reality, the reality is borrowers do need to demonstrate affordability that does take account of the higher interest rate environment, as well as demonstrating some resilience in today's challenging economic conditions, and illustrate that they have sort of long-term sustainability. And importantly, of course, they do need to agree to the terms of the lending, and as I say, in what is a challenging environment at the moment, and with interest rates higher than they've been for quite some time. We are seeing some evidence of offers of finance being declined, and an uptick in that due to the costs of borrowing and the terms being offered. So that's something which we're seeing in the marketplace. But overall, definitely funding available out there and do shop around for it.
Yeah, thanks for that, Mike. So I think just to cover off the final points on this slide, so clearly still challenges. There are options out there for SMEs, but SMEs are no different, I guess, in terms of how they're facing pressures. SMEs are also consumers, and it underlines the reason why you need to take a full view of an SME, both their business and I guess their how they're faring from a consumer perspective as well. And if we move on to the next slide, Stephen, I think it kind of brings us into why, from a DNB perspective, we've been looking at this and trying to solve for this problem within the SME market. Because as we mentioned, there are a whole range of SMEs. SMEs can be medium businesses, which will be very large, and you'll have very small businesses at the other extreme. And really what we're talking about is being able to draw on multiple data sources within the market that can help you assess customers better, be more efficient in terms of how you're processing, be more profitable, identify any financial risks, but have that in a single area under this banner of what we're referring to as the unified risk view. So in effect, a one-stop shop in terms of data sources that you can use and pick and choose what is most relevant within the market. So when we look at what that really looks like, so some of you may be very familiar with where we've got our traditional data sources, and you may already be users of our commercial data. And just to reiterate, we have over 580 million business records. The depth and breadth of our data is unparalleled. And overlaid with that is our network intelligence in terms of how we then link businesses together. And that can be really important when you're looking at exposures or total exposures that you may have to an entity. And not forgetting trade experiences. So on the trade credit side, something that's often hidden in the background, there's all of this activity, which is also very powerful. There's a whole host of other things that we've listed out there, but that's just to give you a flavor. That's our first pillar in effect. Since then, we've had the CCDS scheme that's been around for a few years now, and that's really there to kind of like give us that additional insight. So it's not just about the financials and getting information that might be maybe 12 months out of date. It's about getting information that's more up to date on a monthly basis. And then added to that is our partnership with TransUnion, which gives us that consumer view. So, for those smaller SMEs, and we talked about transferring funds between consumer and, their personal accounts and their business. And that's where you'll get insight on how they are actually performing. Now, the unified risk view doesn't really just stop there. There are other initiatives that we are looking to incorporate as part of that. And the reality is any data source, whether it be open banking, for credit risk, for verification, for fraud, any of those components will come under that banner, because the truth is you need to use multiple data sources to attack various problems. And finally, the SME market is a very big opportunity. SMEs generate 2.1 trillion in turnover. They can help you better automate decisions for credit assessments, better manage portfolios that you have, act decisively when you really need to at the extreme. But the key point here is really, this is a really challenging space to navigate. But at the same time, it's a rewarding space, and that's rewarding for your business, but also for the customers. And ultimately, if it helps the SME customers, it will help the wider economy. So on that point, I will now hand back to you, Stephen.
Thank you, Ravi, and thank you all for such a comprehensive update on those slides. That concludes the slides for today's session, but we have had some questions in the chat while you guys were presenting, so I might just ask a few of those, if you bear with me. So the first one we've had is from Jenna May, and just look at the timing of this grant. I believe it's probably in reference to your macro section. She says your outlook obviously looks optimistic, but are there any risks that you're anticipating in the system that could derail such an optimistic forecast?
Yeah, fairly optimistic. It's a good question. In terms of risks, I think, as Mike mentioned, the upcoming UK budget is clearly a point of risk for businesses. I think aside from that, which is a single point in time, really, I'd probably frame an answer around upside and downside risks to the forecast. I think on the downside, a couple of things, and these are probably related, and they centre around inflation, which to some extent has sort of dominated the agenda lately. So I think to take a look at these, probably need to zoom out a little bit beyond the UK. Conflicts in and around the Middle East and in the Ukraine, I think they're both at very risky stages. I think the risk of escalation in both those regions is very high. What they both have in common is energy production is intrinsically linked to those areas of conflict. And one likely outcome of intensification, as we've seen already recently, could mean higher oil prices, for example. And I think probably the second thing related to that is perhaps the likelihood of increased shipping rates, as we've also seen recently, which has been caused by supply chain disruption. Again, with the impact on lifting inflation more broadly. And so I think the outcome of these two things would sort of most clearly manifest prices. And so we would see some persistence in inflation. And with that, we would have an environment of higher for longer interest rates. So that's the kind of downside risk, I think. On the upside, and I think this speaks specifically to SMEs, is the recent announcement by the government of the new Fair Payment Code, which aims to tackle late payments and hold larger firms to account to get sort of cash moving back into small businesses. I think it will mean that small businesses, SMEs, will be able to concentrate their time developing their businesses rather than chasing late payments. I think it's, on the subject of risk, it's worth mentioning at Dun Bradstreet, we provide regular holistic country risk reports on more than 130 countries, and the UK is one of those, where we kind of identify and provide calls to action for businesses across a spectrum of risk factors. So I think they're worth looking at.
Makes sense. Thank you, Graham. Second question we have here is in relation actually to the CCDS scheme, which obviously Ravi and Mike both touched on. So the question is from Craig, and he's asking, is the data available for all sectors outside of just banking? Ravi, I might go to you for a first answer.
Yeah, sure. So in terms of, is it available to all sectors? Yeah, so any credit scenario that you have, whether that's within financial services or outside of that, it could be pharmaceuticals, for example, you can use our underlying scores. If you have a credit product that you can reciprocate into the scheme, so a lending product, then you can use our scores and the underlying data. So you'll be able to see actual underlying data on current account turnover and values that you may want to use. So that's what I would say on the CCDS part. And I think it's probably worth mentioning also in terms of consumer data, obviously used, and we have our blended kind of capability of our scores. Consumer data also can be an integral part of that, whether that's within financial services and to some extent within outside of the financial services in other sectors. So without going into too much detail, obviously we can provide more details around that. There are specific use cases, permissible use cases that you have, but the short answer is yes. There's limitations on which data and where, but absolutely it's information that can be used.
Understood. Thank you, Ravi. And Ravi, actually a final question addressed directly to you from the chat from Madhu. So it's in relation to the unified risk view, and she's asking, how can you prove if it can be used on our own portfolio? For example, is it something that can be tested on a company's own portfolio of customers?
Sure. Yeah, really good question. So we've actually just very recently, we've been conducting quite a few retrospective analysis for larger clients, larger banks, also challenges, and within the non-FS space, so actually across the piece. And we've got some results back, and actually the best way to do it is to prove it through, looking at your losses historically and then overlaying our scores and then saying what difference would it have made against what you were using today, or if you're not using any scores, what value it would have brought had you had that score or that data in place. So the best way to do it is retrospective analysis, so you can absolutely test it, and that would be something we would be more than happy to do for our clients.
Fantastic. Good stuff. Well, thank you again to our speakers, particularly Mike. Thank you for joining us today, and hopefully we'll see you on another webinar very soon.
You're very welcome.
That concludes today's session. A copy of the presentation will be available on the Bright Talk channel. Please also keep an eye out for a follow-up email in the coming days with a recording of the session plus more information. And if you are interested in the DNB Unified Risk View, do feel free to search online or reach out to one of the team. Thank you very much.